Ladies and gentlemen, please welcome the
1,500
Vice
member
President of
companies.
Stanton A. Moss Incorporated, Stephen Moss.
Good morning. Can you please take your seats? We have plenty of room up front here. Welcome to the 2015 ISRI Aluminum Spotlight. I'm honored to be your moderator again today. I want to thank our sponsor, the Malin Companies, for being a sponsor of us today and stepping up in their long and continued support of ISRI. I'd like to ask people in the audience to silence their cell phones. Please check out the antitrust policy on the seats. So today we're very lucky to have a distinguished panel with us to discuss the aluminum markets. We have John Tomazos, Joe Quinn, and Mike Southwood. But before we begin, let's take a look at the ride we've been on for the last 7 months since I saw many of you in Chicago. There's been a lot of change since September 17th and even since the beginning of the new year, and none of them really for the better for scrap processors and brokers. Since that date, the LME has really dropped maybe about 10%. Aluminum inventories were at 4.7 million tons in September, now are 3.8 million tons. Oil prices have dropped by 40%. The Midwest Premium has been on a roller coaster ride from a little below 22 cents to over 24 cents in January, now to below 17 cents. In addition, the Platts 380 number was at 111.5 and is now at 98.5 cents. We've also seen strengthening of the US dollar to levels that it hasn't approached in over a decade. This strong dollar is, we'll find out what it has done to our markets here. Our first speaker today will be John Tomazos, founder and president and CEO of Very Independent Research LLC, which he formed in 2007, which provides independent research to institutional clients for fixed and subscription fees, covering steel, aluminum, copper, gold, other mining sectors, wood and timberlands, paper, and fertilizers. Previous positions include Vice President, Equity Research Department, specializing in metals securities at DLJ, Senior Vice President for Oppenheimer Incorporated, and Investment Research Officer for Morgan Guaranty Trust Corporation. Tomazos was inducted into Institutional Investor All-American Research Team Hall of Fame in December of 2011, and he earned a master's degree in industrial administration at Carnegie Mellon University. Let's all welcome John Tomazos.
Thank you for the kind introduction and for the opportunity to speak at the ISRI program today. I'm going to focus on two sub-points of aluminum demand and supply. The Indonesian bauxite ban announced January 12 last year, and Chinese metal output. In my studies, those are harder things to model and understand. In fact, the Indonesians adhered to their bauxite ban and produced about 53 million tons less bauxite last year. The world bauxite market's 297 million tons in 2013 reported output, and on average it takes about 5.5 tons of bauxite to make a ton of metal. There was some initial optimism in the aluminum market after the ban. We recommended Alumina Limited, Alcoa's 40% partner, to our clients January 28th last year in the mid-threes, and we downgraded that recommendation February 27 this year in the upper fives. And of course, the aluminum price peaked at the end of August near 96 cents last year. It turns out the Indonesians, while they stuck to the guns, the bauxite ban had almost no effect. The world alumina market was in a 2.5% surplus prior to the ban, and there appeared to be a constraint on metal output or alumina, as reported by the IAI, was less than the equivalent metal output from June to November last year. The IAI reported metal output up 4.8% and alumina output up 1.9% last year. In December, the alumina output caught up with the metal output. And it's important to understand Shaanxi province in China, which is directly west of Hebei in the north that contains Beijing. There are 7 new alumina and bauxite complexes or expansions in Shaanxi province, and there's another half a dozen southern Chinese provinces where there were expansions, as well as in Vietnam, Laos, Myanmar, and Malaysia. So that Southeast Asia and China appear to have entirely replaced the Indonesian output. The IAI does not publish bauxite data. The World Bureau of Metal Statistics, if you pay $4,000 for an electronic subscription, does, but their data has not caught up. So in effect, the Indonesian bauxite ban was a failure, and it backfired on the Indonesians. There also are a plethora of bauxite expansions and alumina expansions in Iran, Brazil, Rusal in Jamaica, Rusal in Guyana, Noble bought out Alcoa in Jamaica, Vedanta in India, Metro Mining in Queensland, and there's another 20 expansions outside of Southeast Asia, which we do not regard as probable. So that there could be 2 or 3 tons of proposed bauxite output for every ton the Indonesians are not making. And that bull case for aluminum hasn't been as lasting as we all wished and hoped a year ago. The IAI on Monday reported Chinese output up 8.9% for the first quarter, after a 10.35% gain last year. China is now 53% of output worldwide. It's actually 53.8 reported for March. China exported 1.12 million tons of aluminum in the first quarter, disclosed as direct exports. There could be more as indirect exports or goods. The world market was about 16.8 million tons, including scrap in the first quarter, or about 14 million tons primary, excluding reported scrap. So the 1.1 million tons is a large amount. China's been exporting at least 15% of steel and aluminum output ex-China, or taking 15% of the share of the rest of the world. China's steel output has fallen this year. Their construction activity has fallen. Their auto production and sales have risen. It appears that the demand for aluminum could be up a little bit, but is not up as much as the output, and hence the rise in Chinese exports metal exports has driven down the LME price and the regional premiums, and now the Midwest premiums. And while the exchange inventories were falling 50 to 60,000 tons a week last September or October, they didn't fall at all in March and have risen 18,000 tons a week, combining LME and Shanghai disclosures over the last 4 weeks. We estimate LME prices this year 85 cents, Midwest premium 16 cents. We believe there's a favorable case for aluminum because of demand growth, which the next speakers will talk about, There's virtually no capacity additions outside China and maybe net reductions over time. And electricity availability declines as power contracts expire and actions such as Alcoa is taking evolve to reduce capacity. The Chinese will buy 68 billion cubic meters of natural gas from Russia after 2017. It's possible their pipelines aren't on stream on time. That gas is priced for the first 38 billion cubic meters at $10 per million BTUs, and the second 30 at $9 per million BTUs, or about 3 times their cost of making electricity from coal. So there is some optimism that power rates will rise in China. The Chinese use 1/10 as much electricity per pound of aluminum as the rest of the world. They're experimenting with 600 kiloamp smelter pots that use 5.5 kilowatt hours per pound, or another 10% less. The Chinese have cost advantages in construction. They build things much more efficiently. The Chinese are being aggressive because they think their smelters are better and build at a lower cost and run at a lower cost. We use $1.20 in our models for long-term LME prices. We think that's a price that is in equilibrium, although the Chinese seem to be very happy to produce at current prices. We use 16 cents for long-term Midwest premiums. Let me stop there and leave time for the others, please. Thank you.
Our next speaker this morning is Joe Quinn, who works for the Aluminum Association. He works to promote aluminum as the sustainable material of choice by engaging federal policymakers, establishing relationships with NGOs, academics, and the business community, and overseeing policy communications to advance the industry's agenda in Washington, D.C. Welcome, Joe Quinn.
Thank you. Good morning, everyone. I want to thank ISRI for creating such a good panel. I think we've all been to 1,000 conferences where we hear one person give one point of view from one presentation. And at a time of such dynamic growth and change, it's great to have these different views on things. Now, these analysts can talk about things that I can't, so I ask you to direct your questions toward them. But I want to talk about the trends that we're seeing in the aluminum industry from our point of view. My group, the Aluminum Association, we represent 104 companies, and we produce global standards, business statistics, sustainability research, and I want to talk about some of that information that we're producing right here. Let me turn to the industry at large. I'll start with what we're seeing in the marketplace in North America. First, our demand picture is extremely positive. Like many industries, we saw a major drop-off in demand during the Great Recession, but we've seen 5 straight years of growth. In fact, between 2009 and 2013, demand for the metal has grown by nearly 1/3. In 2013, we shipped more than 24 billion pounds of the metal. That means we're approaching record demand levels we haven't seen since the mid-2000s. The growth is being driven by a few key markets, especially transportation. I know you guys are well aware of the F-150 and that impact on our industry, so I'll be light on that. But I do want to talk about our other markets. The third largest market, of course, building and construction, is up 10% since 2009 as housing starts and residential construction continues back online. While aluminum can sheet continues to perform well and even expand in the beer market, consumer preference away from soda in North America have been difficult to combat. Since 2009, the overall consumer packaging market has declined by about 5%. And finally, our largest growth market, transportation. We've seen 4 straight years of significant category growth in all segments, but especially the passenger car and light trucks. Using 2009 baseline, the transportation market has grown an astonishing 75% and is approaching mid-2000 record levels. But first, here's a look at how the industry is positioned globally. Today, the U.S. continues to have 10 operational smelters, making us the #4 producer of primary aluminum in the world. behind Canada, Russia, and of course China. And while primary continues to be a critical aspect of our production base, there's no question about the nature of the industry has changed over the last several decades. Overall production in the United States has come back from the depths of the Great Recession. That's the yellow line you see up there on the chart. Even more notably, today nearly 70% of production in the United States is secondary recycled aluminum, a reversal from the 1980s. This means we produce more recycled aluminum than any other country besides China, and we recover more aluminum scrap for recycling than any other country in the world, something you guys are certainly well aware of. Aluminum is already one of the most recycled materials on the planet. It has high value, meaning it is less likely to be thrown away, and it can be recycled repeatedly in closed loop without losing essential properties. Again, as you guys know, remarkably, 75% of all aluminum ever produced is still in use today, but there's still room for improvement, particularly in the consumer packaging space. Altogether, too much aluminum is thrown away, reflecting a loss in the economy and, of course, to the environment. On the primary production side, the industry is also more efficient. We're using less energy and generating less carbon impact than ever before. The North American industry has reduced energy required to produce a single metric ton of aluminum by more than a quarter, and overall carbon footprint of that production is nearly 40%. There are a number of reasons for this, including process improvements and voluntary actions to reduce emissions. But one of the most significant in the industry's move toward using more renewable hydropower. Since the early 1990s, the percentage of new aluminum produced using hydropower has grown significantly, while the percentage of using coal has dropped. To shift gears for a minute to slightly talk about how some macro trends we're seeing and why we're excited today. Overall, I think it's fair to say that the industry is extremely optimistic about what the future holds. In aluminum, two big reasons for this. First, the return of U.S. manufacturing. I don't have to tell this room about the importance of domestic manufacturing, but here are a few top-line statistics on the screen here. Taken together, the U.S. manufacturing sector is equivalent of the 9th largest economy in the world, and for the first time in a long time, we have reasons for real optimism. But here's the second biggest reason why we're optimistic. The aluminum industry in particular is on the verge of significant, some could argue transformative growth. Just as building and construction emerged in the 1930s and 40s, aerospace 50s, 60s, beverage can market in the 70s and 80s, today we're looking at massive opportunity in the automotive space. The reason for this is aluminum's key differentiator, its unique position as lightweight and extremely strong. As you can imagine, at the association, we are very proud of these charts, and I'm sure you've seen them 1,000 times, so let me fast forward through these. These are summaries of the Ducker study that was released last year showing the growth in automotive, but again, I know you guys know that. Growth like this means the challenge for our industry may suddenly become not is there significant demand for our metal, but what do we have to meet the demand coming online? And that's why we're already seeing major investment announcements. Since late 2013, the industry has announced several major new projects and expansions to meet this demand challenge. This will pump more than $2 billion of economic manufacturing sector over the next several years, and we conservatively estimate that this will expand U.S. auto sheet rolling capacity by around 2 billion pounds. So clearly we're very excited about the auto opportunity, but that's not the only story. We believe the country and the world is moving to a place where material lightweighting in general will become increasingly important, and that's why aluminum is positioned well, and the manufacturing picks up speed. We believe there are two complementary forces driving this trend. President Obama's announcement in 2011 of new CAFE standards of 54.5 miles per gallon. And on the private side, we're seeing companies across the spectrum touting corporate sustainability efforts as consumers demand greener, more sustainable options and greater energy efficiency. And the good news for aluminum is that we can help companies achieve both of these goals. Thank you for your time. Let me go ahead and turn it over to Crew. Thank you.
Thanks, Joe. We'll be taking questions from the panel after the last speaker. Our last speaker today is Mike Southwood, who is a senior consultant with the CRU aluminum team and joined the company in 2006 via the acquisition of the Commodities Metals Management Company. Mike covers the full value chain of the North American aluminum sector and is a primary contributor to the team's publications and price forecasts. Mike also serves as CRU's in-house technical analyst for LME metals prices, providing critical insights into the risks around short-term price movements. Let's welcome Mike Southwood.
Thank you very much, Stephen. Appreciate that. Hello, everybody. Nice to see everybody again. As Stephen said, my name is Mike Southwood. I'm a consultant on the aluminum team for CRU. For those of you who don't know, CRU is a London-based research and consultancy group with offices around the world in Santiago and Mumbai and Beijing, just for example. I work out of the North American office, which is located in Pittsburgh, Pennsylvania. Today I'm going to present a brief market outlook to you, but before I do, I'd like to thank ISRI for allowing me once again to be part of the Spotlight on Aluminum. This is my third time, so I guess I must be doing something right. However, as Matt Kripke told me last night at the opening gala, don't mess it up. Of course, he used more colorful language than that. For the sake of time, this is what I will be talking about today. Now, I know we've all seen this image of the rise of the Midwest Premium over and over again, but it amazes me every time I see it. You know, I include this slide to show the large increases experienced in the Midwest Premium in 2012, how they stayed elevated in 2013, what happened last year, and where we are now. You know, premiums rose through last year, hitting all-time highs along the way. You know, LME warehouse queues and contango financing deals both played a major role in supporting premiums over the last year. You know, but CRU expects these two pillars of high premiums have started to crumble this year. Warehouse queues have already started to come down, but are still high. And this is being addressed by a new consultancy, consultation by the LME aimed at shortening the queues faster. Meanwhile, smaller contangos and higher interest rates will hurt the profitability of finance deals. But before we talk about the future of the premium, let's start with a look at the past. You know, what were the factors behind the rise in the Midwest Premium? Are they still in effect? And will they continue to place upward pressure on the premium? And here we have listed a traditional and non-traditional drivers that have had an effect on the premium over the last couple of years, some more than others. You know, except for the warehouse incentives, which have been marked off, all these drivers are still in play and will be discussed during this presentation. You know, at the root of the Midwest Premium is the structural aluminum market deficit in the U.S. You know, one of the reasons the Midwest Premium even exists is because the U.S. is in a constant state of deficit. We consume more aluminum than we produce. You know, demand, as you can see, has steadily increased since 2009. Meanwhile, production in the U.S. has just not kept pace and has been on the decline over the last couple of years. You know, as a result, the U.S. remains in deficit, a deficit which continues to get larger and grew to over 3.5 million tons in 2014 and will grow even larger this year. The increases in the North American market deficit have no doubt played a role in the increasing Midwest Premium. This chart shows the U.S. deficit in blue, U.S. net imports in red, the subsequent net import deficit balance in gray, and charts the annual average Midwest Premium in green. The relationship is clear. You know, as the net deficit grew larger, so did the Midwest Premium. You know, in order to satisfy this growing deficit, you know, no more material either needed to come from imports or from warehouse stocks. Both of these sources have placed upward pressure on the Midwest Premium during its recent rise, but did either one, you know, have enough strength to push the premium as high as it went? You know, to begin to answer this question, let's start with a look at imports. This is a graphical representation of this relationship between import location and the premium. You know, as the chart shows, from 2010 to 2012, the Midwest Premium rose while imports from Canada and South America dropped, and imports from Russia and the Middle East increased. As it cost more to transport metal to the U.S. from the Middle East or Russia, the more we brought in from these locations, this placed more upward pressure on the Midwest Premium during this time. But this relationship broke down in 2013 as Midwest premiums continued to rise while more metal was being imported from nearby Canada and less from farther away locations. Now, this illustrates that, you know, there were other factors at play that upwardly affected the premium in 2013, like what was going on at the warehouses in Detroit. In 2014, imports increased yet again on a year-on-year basis, but less came in from Canada, you know, while much more came in from farther away, you know, a majority of which came in from Russia. This dynamic continued to have an upward effect on the Midwest premium last year and will continue to have an effect as imports to the U.S. will continue to be provided from Russia and the Middle East. However, while the relationship returned in 2014, it was not enough to drive premiums as high as they went last year, which brings us to the second way the market deficit is satisfied other than with imports, and that's with LME warehouse stocks. On the warehouse stock side of the equation, we have the situation in Detroit, where metal has not only been stuck in long queues due to increasing levels of canceled warrants, but metal was also unavailable due to being part of long-term contango financing deals. These dynamics placed upward pressure on the Midwest premium between 2010 and 2012, helped them stay elevated in 2013, and pushed them higher last year. And while we mentioned that the deficit and imports placed some upward pressure on premiums during those years, it was the situation in Detroit with finance deals and canceled warrants and queues that had a much greater effect on keeping the premium elevated in 2013 than any other factor, which is why the LME targeted this issue with its warehouse reforms. Canceled warrants have been falling, but it wasn't until recently, however, that declining canceled warrants coincided with the falling premium. So if the buildup of canceled warrants were one of the main reasons behind higher premiums, why then, when canceled warrants declined between May 2014 and January 2015, did the premiums continue to grow? Wouldn't a slowdown in canceled warrants lead to shorter queues? Will the queue shrink if canceled warrants continue to go down? Well, yes, naturally, because less metal will be in line to leave. But they didn't shrink at a very strong rate, and this didn't help those who needed metal because it's likely the metal coming out was already accounted for in one way or the other. So in this case, just because the queue may shrink, it doesn't necessarily mean the Midwest premium will go down. This can be seen in the chart in this slide. Since canceled warrants started to decline in May, marked by the vertical line, the queue declined as well, but the Midwest premium continued to rise. So what was it then that kept such upward pressure on the premium, while canceled warrants and queues were falling? A major issue that kept upward pressure on the Midwest premium and that hardly gets talked about is the fact that at one point nearly all the aluminum warrants in Detroit were canceled. While canceled warrants and queues at Detroit declined from April 2014, the percentage of aluminum stocks that were at Detroit accounted for by canceled warrants continued to grow until 98% of all aluminum warrants were canceled. This is the direct correlation that helps explain why premiums continue to climb while queues and canceled warrants declined. Excuse me. The percentage of aluminum stocks in Detroit accounted for by canceled warrants dropped for the first time in a year, falling by 10% to 88%. This coincided with the first time the Midwest premium dropped in a year. I don't believe this is a coincidence, and this is just one final piece of evidence of how this is a key factor in future premium direction. Which brings us to our forecast for the Midwest premium for the remainder of this year and next year. The impact of lower queues and reduced attractiveness of warehouse financing deals will lead to continued falls in the Midwest premium this year. The introduction of the LME load-in, load-out rule in February has led to lower warehouse queues at affected warehouses in Detroit and Vlissingen. A fall in warehouse queues at Detroit and Vlissingen will remove a key support for premiums and lead to downward pressure on premiums. Crew expects queues at the LME warehouses in Detroit will reach the target length of 50 days by the first half of 2016. Crew forecasts the quarterly cash to 3-month contango to average $20 a ton in 2015, and that the year-out contango will also shrink. This, in addition to increasing interest rates, will lower the attractiveness of financing deals, which will remove another key support level for premiums. And here's a breakdown of Crew's premium forecast on a quarterly basis through Q4 of 2016. For time's sake, I won't go through the entire one, but I do want to mention how, I want to point out how we expect the Q2 average to be 16 cents a pound, with prices or the premium dropping so fast at already 16.5 cents per pound now here in April. I would expect that to be looked at quite carefully the next time we do our forecast. Now here you can see Crew's forecast for the annual average Midwest premium for 2015 and 2016 against the backdrop of our market balance forecast. Even though the 2015 market deficit is expected to increase by 7% to 3.7 million tons, we expect the annual average Midwest premium will decline to an annual average of 15.2 cents per pound. Even more, as the deficit increases to over 4 million tons in 2016, the premium will drop at a faster pace to average 7.2 cents per pound. Now, traditionally, larger deficits would mean larger premiums. But this just goes to show how the removal of non-traditional drivers, such as queues and finance deals, will have a more negative influence on the premium over the next 2 years than the deficit will have a positive impact on the premium. Even so, it's safe to say that without these market deficits, the premium would be much lower. And it will continue to support premiums, keeping them higher than levels that we saw before 2011. And again, in summary, I don't need to read these to you, and I'm getting close to my time, so I will move on. If you want to take a look at this, you feel free to read it later. This brings us to the aluminum market outlook. Now, despite the well-documented slowing of the Chinese economy as it transitions more toward a domestic-led economy, it was still the fastest-growing market in 2014 at 12.4%, and will also be the fastest-growing market in 2015 at 9.2%. We expect solid growth in transport markets and other industrial sectors, along with faster growth in packaging market, including cans. Even the construction sector will see shipments grow at 5% per annum in the next few years due to ongoing urbanization and social housing programs. Outside China, other Asian markets should grow at a similar pace in 2015 as last year. However, we do expect slower growth will occur in Japan. Within the developed world, as North America is the key driver, led by the automotive market, but recoveries in construction and other sectors will also help. CRU expects the North American consumption grew by 5% in North America and will grow by an additional 5.2% in 2015. In 2015, global demand will grow by 6%, with the world ex-China growing by 2.8%. And as you can see from the chart, China in 2015 represents over 50% of global demand. The construction sector, which is the largest end-use sector in China, now accounts for 34% of Chinese semis demand. Weaker construction activity in China's urban area will lead to demand growth accelerating through the forecast period. However, the construction sector is the biggest downside risk to our Chinese demand forecast, and a sharp contraction here would have severe implications for the aluminum industry. High debt and inventory levels in the Chinese construction sector remain a serious concern. The government is aware of risks of future or further economic slowdown and has started to implement some moderate stimulus policies. A policy to help the property market is aimed at stopping the slide in property prices, which is one of the biggest risks to Chinese economic growth in 2015. And here we have a look at Chinese production and world ex-Chinese production. And again, in the sake of time, I won't really go over this. John already reviewed the Chinese production very nicely, so no need to elaborate. Basically, it's just a tale of two stories between the heavy production in China and sort of flatlining production in the world ex-China. So, what do we expect from the market balances over the 2 years? Outside of China, we expect continued deficits as demand grows and supply discipline holds. In China, we expect a continued large surplus to build. This is the biggest risk, as more metal could come out of China in the form of semis or primary metal disguised as semis. China puts a 15% tax on primary ingot exports, but there is a 13% VAT rebate on semis imports or exports, thus encouraging more exports of semis and not just prime. Chinese producers have been clever in producing continuous cast CC coils that are just remelted again, in effect a primary metal export. This avoids the 15% tax and rewards them with a 13% tax rebate. A rising primary surplus and positive CC coil arbitrage has fueled yet another surge in primary exports under the semi-trade code. However, CRU expects exports of CC coil to ease over the remainder of the year as premiums outside of China fall and sheaf prices move higher on improved demand. Exports of genuine semis from China have also remained high and continue to negatively impact primary demand in the world ex-China. The exports were mostly sheep to the USA, Africa, and Asia, and CRU expects that exports of genuine semis will continue to rise this year as Chinese producers ramp up capacity. And again, this is a look at CRU's quarterly forecast for prices throughout Q1 of 2016. Cruise price distributions have shifted lower recently, as difficult market conditions are expected to keep LME prices lower than originally forecast. We expect Q1 2015 will still be the low for the forecast period, but Q2 will not be much stronger. Prices will rise in the second half of the year to an average of $18.78 per ton in Q4. It is not shown on this chart, but we expect the LME cash price will continue to grow in 2016, but only modestly, rising to an average of $19.13 per ton in Q3 and averaging $1,900 a ton in Q4. With the expected drop in the Midwest Premium, the average all-in price will drop from $1.05 per pound in Q1 of this year to 92 cents per pound in Q1 of 2016. So I apologize for taking time there, but I just wanted to make sure I got through some of that important information. So thank you very much, everybody. If you have any questions, there's my contact information.
Right.
Thank you very much.
Thank you, Mike. That was a very informative. Thank all of our panel for their great presentations. There are mics right off the center section of seating in the room if anybody has questions. But I have a couple questions to start off with. So Mike, that was a pretty pessimistic view for the aluminum market, at least for our participants in this room. John, how do you feel about, where do you